The Exit Series is produced for general information and educational purposes only and is not investment, legal, or tax advice. Views expressed are those of the host and the guest and do not necessarily reflect those of any affiliated firm. The host is associated with an SEC-registered investment advisor. Nothing herein constitutes an offer or solicitation of advisory services. Guests are not necessarily clients. On this episode, we have Ruben Ramirez. He's a director at Blue & Company, LLC. He's located in Franklin, Michigan. He's a CPA, an ABV, and I had to look, accredited in business valuation, and a CEPA, which is Certified Exit Planning Advisor. He works closely with manufacturers and distributors to navigate industry-specific financial and operational challenges. He has extensive experience advising closely held businesses and their owners through the complexity of the sell-side M&A transactions, ESOPs, and succession planning. Ruben, welcome. You and I met in Nashville. Tell us a little bit about your firm and who you serve.
Thanks for having me on today's show. And as you mentioned, I'm a director out of our Metro Detroit office. We're about 15 minutes away from downtown Detroit. My firm is Blue & Co. We are a top 60 CPA firm, full service. So, our services do include the traditional accounting and tax functions, whether it's a year-end financial statement, tax compliance, tax planning. We prepare 1040s, gift returns, trust returns. In addition to just the traditional core compliance work, for me specifically, I do lead our transaction advisory group on the tax side, which is referred to as Blue Value Advisors. I've worked in the industry for close to 15 years. I've worked on over 200 transactions, all closely held businesses with enterprise values ranging from $2 million on the very low end, north of $500 million, with the meat and potatoes being right around that 15 million in enterprise value to 50 million in enterprise value. Being from Metro Detroit, there is a heavy manufacturing and distribution presence here, which is why I do and I am involved primarily on the manufacturing side, but have been involved in several different industries from a transaction perspective, and do focus more on the sell side, advisory side of the business.
For you, with your credentials, you ended up at kind of the intersection, of the operational side of a business and the M&A transaction side. You had with the ABV and the CEPA. When you started pointing toward that direction, what was the thought process that took you to those particular designations?
Well, it wasn't really so much a thought process as much as it was I was kind of forced into my situation. So prior to in Detroit, right, but specifically on the M&A side. So at my previous firm that I was with, where I served on the tax side for about 10 years, we did a lot of transaction work, and that transaction work was primarily done with one partner in the office. And as you may be aware, transactions can be exhausting, daunting, time sensitive, and for one person to manage that for an entire firm, it could spread that person thin. So I was basically forced to attend every transaction call, to review every IOI, LOI, to help redline every purchase agreement, to structure every transaction, to prepare a net proceeds analysis, an asset or stock sale analysis on every deal. And over years and years of pain and agony, I developed my expertise and gravitated towards the M&A field. And working with M&As, it made sense to get the CEPA certification as well as the ABV credential.
You bring up an interesting point. We oftentimes hear of deal fatigue on the owner side, right? And you're on the other side of the table. Do you not have knock-on effect on deal fatigue as well?
Oh, absolutely. Especially around the holidays and year end, because a lot of businesses like closing before 12/31, and it 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 can be exhausting. I do manage a full book of business. Roughly, I manage about 2.5 to $3 million of practice of traditional compliance work, and I touch practically every engagement out of our office and a significant amount of engagements throughout the entire firm, which consists of, north of 15 different offices. Um, it's less and less more fatiguing now just because I've been in the industry for so long and I've had so many at bats. Um, the parts that can be exhausting is when you're coming across new concepts or new challenges that you haven't faced before. But
Mhm.
given my level of experience, I've kind of uh, came across my fair share and feel a lot more confident and know that when I'm on a due diligence call with 12 other CPAs at big four CPA firms and I'm able to basically hold my own in front of all of them, you develop a level of comfort and confidence.
Veteran. Oh boy. You joined Blue and Company in 2024. What motivated or prompted you to move to Blue and Co? And is that what you're doing now? It doesn't sound like it's significantly different than what you did before. What did Blue and Co provide that you didn't have before?
Yeah, so our office actually merged in with Blue about a couple years back. And in the CPA profession in general, there is a ton of consolidation occurring. So a lot of the regional firms have basically disappeared. Um, and really, it seems like the industry is going to consist of the top 100 firms or very, very small sole practitioners. So again, this wasn't really a choice of mine. It was a strategic choice of our office that we needed to diversify some of our risk in relation to human capital, because that's another uh, area of pressure that the industry is currently experiencing, is that not a lot of college students are going into the field of accounting and taxation, and even fewer are going into public practice because of the workload and demand. So being able to be part of a much larger firm, again, a top 60 firm that consists of 600 professionals, does provide us with a bit more risk diversification in the event that we had some staff leave, as well as we are able to offer additional services that we just didn't have in house previously. So a much deeper bench.
Okay. Makes sense. Yeah. And it's a trend for sure. Um, when I hear about manufacturing and distributing, I'm in Colorado, so my manufacturing distributing base is likely different than what you have in the Detroit area. Are there specific segments in those verticals that you specialize in, or I guess draw me a mental picture of a manufacturer and or a distributor.
Yeah, so I mean, generally speaking, in Detroit, a lot of the manufacturers and distributors are auto related. Out of coincidence, I don't actually have a huge percentage of those auto related clients. I have a lot of niche manufacturers. For example, I have a client that does about 60 million in revenue that manufactures bulletproof glass and does business in all 50 states. I have another client that does fire extinguishing suppression solution for all 50 states. Again, about 50 to 70 million in revenue, operates in multi states. Um, and it's those attributes that are pretty consistent across all manufacturing clients, right? They're capital intensive, they carry a heavy network of capital, they tend to operate in multi states. There's nexus exposures related to sales and use tax. So when it comes to manufacturing distribution, that encompasses a huge industry, a lot that have overlap in a lot of the same traits that might apply to like an automotive supplier compared to a niche manufacturer.
Mhm. And we were talking about deal flow and your experience. The days leading up to the close on a manufacturing sell side transaction, What does your daily tempo look like? And are there any markers or indications that you watch out for from the owner?
So I guess answer the last question. Not specifically indications from the owner, more so indications from the deal team. Has communication really sped up? Has it slowed down? Um, is it reasonable that we're going to close in 2 days? You know, given that we're missing 15 different illustrations that have to be attached to the APA. It's really at least in my opinion, what indicates whether the transaction is actually going to close on time is the intensity, and that's how I would describe that week leading up to the closing is that it's incredibly intense. Um, you're still in the process of basically working with the attorneys and looking at the last turns of the purchase agreements. You're still redlining some items here and there. We're still putting together illustrations to be included in the agreement. We're in the process of drafting up pro forma balance sheets for purposes of determining the net working capital calculation and the PEG. It's exhausting. I mean, whenever we have a closing, we try to carve out a few days prior to closing, knowing that it's going to be a very intense process and that there's a lot of things that have to be done last minute in order to get the deal through the finish line.
You know, what was on my mind that you were talking about that is your pre-life when you were involved, and I don't know where in that sequence that you got your business valuation accreditation. When you when you did get that, do you think that helped your perspective, expertise, abilities when you got the ABV?
To an extent, the ABV really is, in my opinion, geared more towards valuations that are used for gifting purposes, fair market value assessments. When it comes to valuations that are added to a purchase agreement or an IOI or an LOI specifically, um, a lot of times that's based off the multiple approach. So there's a lot more concepts that the ABV dives into that really isn't as applicable to working in the M&A space. It's good to have a general understanding of how valuations are determined and the differences between the income approach, the asset approach, and looking at discounted cash flows and understanding what those one-off adjusting entries are and what are the normalizing adjustments and um, basically how does a formal valuation, how is it put together, what considerations must be accounted for. But when it comes to the transaction world, a lot of that stuff kind of goes out the window and it's usually market based, right? Let's look for competitors, let's look at what they sold for, let's look at a leverage buyout analysis and what this business would be able to service from a debt perspective. So it's not really comparing apples to apples, but it's just a good fundamental understanding and foundation from a technical perspective of the concepts that apply in the valuation world, which do trickle down to the M&A side as well.
Okay. You know, switching gears a bit, the wire lands and you did the valuation and, the numbers just confirmed and, or it was negotiated. What is that moment when that finally happens? What does that look like from where you're sitting?
I feel like I just finished a marathon when that happens. When the wire lands, when the closing funds are rolled out, when we get our fees paid for, um, it's relief because again, the weeks and months leading up to closing are incredibly exhausting. The due diligence process is um, uh,
I'm going to turn this off. I apologize. If you
no
cannot tell,
worries.
the cell phone is set for duck hunting. I like to duck. So it quacks instead of rings. So apologies.
Yeah,
So
no worries at all. Just a sense of relief, just because there's been so many hours and hard work that have been put into getting to this point of closing, which really should happen, 2 or 3 years in advance when it comes to preparation.
Yeah.
Oftentimes, as an M&A CPA and also on the M&A attorney side, our two professions and our areas of specialty tend to get pulled in kind of last minute, after the LOI is signed or after there's an initial draft of the APA. But really, we really need to be involved and brought into the discussion 2 or 3 years in advance of the transaction so that we can help position our clients to best negotiate the transaction when something is proposed to them, and making sure that we're in a position to really negotiate the LOI to be as favorable as we can from my perspective from the sellers, because I do a lot more of the sell side advising.
You mentioned the advice and work on the LOI. Do you find that the sellers are as focused on LOI terms as you are, or are they more unaware?
They are not as much focused on the terms as I am. And in my opinion, the seller's highest point of leverage is on the very onset of a transaction. And that really is the LOI. What's included? What are the terms? How is it going to be financed? How is it going to be structured? What's defined as a tax favorable sale? Does that mean they're going to buy my stock? Does that mean if they're not going to buy my stock, are they going to propose a cash true up that would normalize my net proceeds as though I sold my stock? What's the exclusivity period? What is my management incentive compensation plan expected to be? What are the holdbacks? You want to be as explicit as possible, because it's really the LOI that lays out the economics of the transaction. And although it's a non-binding agreement, the intention is for all those economics to be laid out. And it's much easier to hold the buyer's feet to the fire when you have clear expectations and clear outlines in advance of signing the LOI than trying to fight for those items after the LOI is already signed and you're already down the due diligence process. In my opinion, I think that is the most important aspect, is negotiating the LOI.
That's a common thread that I'm hearing frequently, and I don't think that's that well known or recognized, perhaps. In manufacturing, specifically equipment, real estate, customer concentration, workforce, what's the thing that surprises your owners at the close that your valuation was already accounting for, but I think maybe the gravity of that didn't land until that moment? Is there something that pops up then?
Not necessarily on the valuation side, but probably the largest point of contention tends to be around the net working capital adjustment. And for those who are kind of unfamiliar with the concept, I like to use the analogy that net working capital is similar to a U-Haul in the gas when you rent a U-Haul. When you go out there and rent a U-Haul, one of the first things that they do before you leave the U-Haul station is that one of the workers will go out to the truck, they'll look at how much gas is left in the truck, and they'll say, hey, when you bring it back, if you're going to leave with a half a tank, you have to bring it back with a half a tank. It's the exact same concept when it comes to net working capital. When you sell your business, you are going to deliver that business with a certain level of net working capital. And if there is a shortfall, then you have to pay for that shortfall. Or alternatively, if there's excess working capital, then you get to walk away with that excess, and it just increases the total consideration of the sale. So a lot of sellers oftentimes will be surprised that at closing, they may have to adjust their purchase price down or bring cash to the table for the shortfall in their net working capital. And that's because they weren't effectively managing their working capital 18 months, 12 months in advance of the close. But that could be significant points of contention. I've seen net working capital adjustments and shortfalls that were multi-million dollars that ended up causing the transaction to go in legal dispute.
What strikes me is, one, why do you think that is? And two, when you start working early with a company, how do you pre-frame that so that doesn't end up being an issue for your clients?
Yeah, so that's why I stress the importance of working with a M&A professional on the CPA side well in advance of the transaction so that one, they're educating you on what's customary in a deal. How was the deal structured? How is the purchase price or total purchase price determined after including the net working capital? What is a buyer going to come in and look at? And we want to avoid surprises, right? So we're going to clean up the balance sheet 24 months in advance of a transaction because we know that when buyers come in during due diligence, they want the last 12 to 24 months of trailing balance sheet and P&L activity. So we want to, again, make our client and put them in a position where they're already have clean financial statements and they're already in a position to really negotiate the transaction from their perspective.
Yeah, and again, one of the things that I hear frequently is the working capital, negotiating toward the close, and it's an unhappy event if it becomes a focal point. So, in your work, you hold both the numbers. You valued the business, or you could have. You know what it's worth. You know what the owner needs that sale to generate. When those two numbers don't match, you're kind of in the middle of the gap, and you have visibility. How do you navigate that conversation with the owner that needs X, and it looks like it's going to be worth something less than X?
Well, it really actually does help with the conversation and makes it a bit easier because you're able to quantify what is that value gap, right? My business is operating with this level of EBITDA, and based on this EBITDA and this multiple, this is what my expected enterprise value is. After taxes, after my debt payoff, this is what my net proceeds are. But I know that I need X amount of net proceeds in order to really live the lifestyle that I want to live post sale. And then we just defined what that gap is. And now we could reverse engineer the operating side and identify, what can we do to either de-risk the business or to grow profitability? Does that mean that we need less customer concentration? We need more product diversification. We need to increase growth rates annually. We need to reduce our fixed costs. We need to, have our key employees tied in with some type of phantom agreement to help drive value, to allow the business owner to have less of a material participation in the business so that it's more turnkey for a buyer. There's a lot of elements that we could identify, but step one is just quantifying what that gap is and then working backwards to identify what do we need to change at the business level from an operational perspective to achieve that net proceeds at exit that we need in order to bridge the gap.
Boy, that was a bunch. The de-risking the business, and then you basically laid out customer concentration, owner dependency, and any number of factors. When you have the time to work with a business owner pre-exit, and you're looking at it, and you go, we have a tall order to de-risk this business to get it ready for sale. What's that like with the business owner? Do you think, in your experience, are they aware? Or are they absolutely just not aware?
No, oftentimes they tend to be aware and they realize that they're operating a lifestyle business and historically they really didn't mind that because the lifestyle business was feeding $1 million into their pocket on an annual basis. Um, and they just didn't really want to make the investment at that point in time to really make it a lifestyle business to more of a turnkey business. So they oftentimes are aware of those challenges and just really haven't had to be put in a position where they've really had to focus their efforts into transitioning from a lifestyle business to more of a turnkey business. And it is a tough discussion just because it's, you never want to call a client's baby ugly.
It's unique. It's not ugly. It's unique. I like it.
Exactly. And identify the challenges. And what I tell all my clients, like, I will never know more about your business than you do. I could tell you where, there's risk. I could tell you what's your exposure. I could help quantify what needs to be done, but you're going to know more about your business than I ever will. I mean, you run into business owners who could basically operate their business by just looking at the bank, looking at what customer deposits they have on the balance sheet, knowing what's sitting in AR, knowing what's sitting in AP, knowing, how the industry is doing by just talking to some of their suppliers and customers. They have a much closer pulse on the market than I ever will. For me, I've just seen so many of these transactions that I could identify, what are those critical components that we can tweak that would really magnify the outcome in a favorable perspective.
You know, in your experience, do you think that the business owners you've worked with through the transactions recognize the value of the insights and structure and changes you bring to the table and how it affects their net sale proceeds? Basically value increase from the work that you guys do. Do you think they really know that math or appreciate it?
I don't think they appreciate it until it's been quantified to them and and explicitly identified, hey, as of today, you're here. If we change these mechanisms of your business and get to this point, that's what these will result in. If we get to the next point, that's what these changes will result in. And I really do think you have to break it down and try to make it as simple as possible in order for them to grasp the concept. Because our fees might be $50,000 to $100,000 a year and trying to accelerate the growth, but that is might result into an additional $50,000 to $100,000 of EBITDA, and you take that EBITDA times a 10 times multiple, and that's $1 million in enterprise value that you just created. So
Yeah.
a lot of times that's lost until you actually map that out to the business owners. And I think that's what it really takes in order to make them feel comfortable with engaging a professional to help them grow the business.
I think my observation that's underappreciated, truly. And I think about the business owner that falls in love with this business again after it's operating. And I suspect there's some of that goes on too. You go like, I had no idea it could be like this.
Yeah, I had no idea that I could work 35 hours a week opposed to 50 hours a week and make a lot more money and
Yeah.
have less participation and have happy employees, and they may change their mind.
Yeah. Yeah. I hear of those. In the manufacturing side, when the sale closes, the owner identity is, favorite machine that dad brought in the second generation company, the shop floor, the people that run the lines. What do you see in the owner in the first few weeks after the close that perhaps you wouldn't see in a tech business or some other industry? What do you typically see?
I don't know if it's necessarily within the first few weeks. I think it's probably within the first 6 months or the first year. But to your point, when you're a manufacturer or a distributor, you tend to be showing up to an office every day. You've spent decades with some of your key employees in growing your business. You developed a regimen that you're just accustomed to. Um, and a lot of times when you sell a business, those owners will likely be, active still with the buyers for a period of time. They might have an employment agreement for 6 months to 2 years just to help with the transition. And I would say that the first hurdle that I tend to see business owners encounter is, hey, I'm an employee now. I'm no longer an owner. Like, what I say doesn't necessarily go. I can't, just leave when I want to. I can't just charge expenses to my business when I want to. Um, that's the first hurdle. Once they stop showing up as often to the shop because that employment agreement has lapsed, then I think that's where reality really sinks in. For a lot of these business owners, it's about legacy. Again, it's taken them 20, 30, 40 years to build a business and to sell it. and tell them to go do something else is not going to feel normal and comfortable to them. On top of that, they no longer are the driver of what happens to their employees. That's now in the arms and the hands of the buyer. And that could cause significant issues. From my perspective, one of the most important aspects of seller due diligence, because sellers need to do their due diligence when it comes to the buyer, is making sure that there is a culture fit. Because if there's not a culture fit, and if you're leaving your company to a buyer that's going to basically wipe out your entire management team, is going to lay off 30% of the administrators that are with the organization, that is going to ruin the legacy of your name. That's where I see the most challenging aspect being encountered by the sellers, is that seller's remorse. And if I would have known this about the buyers, I would have taken a lower purchase price on the front end or sales price, and I would have gone with someone different. So I think it's incredibly important that you know who you're getting in business with, because a lot of times there is a legacy that exists with the seller's organization, and oftentimes that's more important to them than the dollars that they're ending up with in their bank account.
That brings to mind, I was talking to another business owner. He was talking about integration risk, right? And I asked him, what do you mean? He says, well, it's everything all at once kind of thing. And is there advice you would offer to business owners about to exit where they knew, just here's the top 2 or 3 things you need to keep in mind when you're negotiating post-sale responsibilities and so on? Is there something you would offer to them as advice?
Yeah, once the deal closes, I would suggest really it should happen during due diligence, but you don't want to hide any skeletons in the closet from an operational perspective. If there's key employees that, their dynamic is a little bit unique, or if there's challenges that are being faced within the company itself, to really lay that on the table and not to hide that. Just because, when a buyer comes in, and oftentimes sellers are, rolling over a percentage of their sale, they really are looking for buyers to help provide some insight, especially if it's strategic, and oftentimes even on the PE side. So getting an outside perspective is also very helpful, and you never know what experiences the buyers has had that could help with the existing integration, but try to be as transparent as possible from an operational perspective. A lot of
Yeah.
times sellers are not saying they're trying to hide items, but they might not be as forthcoming because they're concerned about the implication on the sale price and the terms of the transaction. But I think sellers may think that it's going to be a lot more detrimental to them if they were to vocalize those concerns. But I think it does show that you're being a good partner to the buyer, especially if there's some type of rollover equity that's involved.
Your engagement as a Blue Value Advisor, what does that specifically represent? What does that role cover that a standard CPA relationship might not?
So we have just had more at bats. I'm considered a member of Blue Value Advisors because of the amount of engagements that I've been involved with. Normally, a CPA doesn't regularly work on transactions throughout the year. Their focus is more on the compliance side. And same thing with an attorney, right? If you have an in-house corporate attorney. So it's just important that you're working with practitioners that have the experience and understand the customaries of the transaction and of the industry, because it's the most significant financial transaction you know, of your life. At least you would expect it to be, unless you plan on hitting the lottery. It's important to make sure that you're working with professionals that are well equipped. Do they understand what the buyer is going to look at in due diligence? Is the sales and use tax filings, are those all in order? Are the income tax filings in order? How clean are the month-over-month financial statements? How do you how do you structure your entity prior to transaction to prepare for a sale? How do you negotiate the net working capital calculation? Um, it's just the experience level. That's what it comes down to.
Yeah, you don't want to be in the boat with the owner says, this is the first time I've ever sold a business. Yeah, me too. That I don't, that's not, that's not a good equation there. In your experience, when you've got a manufacturing owner, whose post-sale year went the way your planning expected, you put all the value drivers in, did all the pre-work. What did they have going for them? Was it financial prep, personal prep, or something else?
Oh, both, and well in advance of the transaction. Again, they've thought out the sale process. Those tend to be sellers that didn't just sell to someone that just knocked on their door a few weeks, in advance. The successful sellers tend to be people who have already came to the conclusion that they want to sell. They're working with professionals well in advance of the sale in order to prepare themselves for a successful exit. They've already thought about what are they planning to do once they sell the business, what level of participation do they want to have after the deal is closed, and how do they want to spend the first couple of years after the sale from a personal perspective? Do they want to travel the world? Do they want to spend time with their kids? Again, you're changing your entire lifestyle, and you have to be prepared in all aspects, financially, but also personally. So it's those people who have really put the time and consideration in advance to make sure that it makes sense for them to go ahead and pull the trigger, and that they prepare for it in all aspects.
In your experience dealing with the business owner, there's the pre-exit, post-exit. Where do you think the gravity lies? Are they really more focused on getting to the exit, or do you think they appreciate the gravity of what next after exit?
No, I do think that they're probably more focused on getting to exit and getting the highest multiple that they can, which again is not always the best driver of what should be triggering your decision. Um, I personally think that people put too much value in the enterprise value itself, and really should focus on, what does this mean for me? What is my value gap? Like, what is that lifestyle that I want to live post sale? How much do I actually need? What would I consider to be the icing on the cake? What will actually make me happy from a personal level outside of just the dollar amount? That's what the focus needs to be on, not just what's the highest multiple I can get.
Yeah, in thinking, on the other side of the coin, without naming names, an exiting owner whose post-close year went sideways, what did they plan, or where did the execution fall short? In hindsight, what did they fail to do or catch?
Oftentimes, they fail to get us involved well before the transaction. They negotiated, or they did not negotiate the LOI. The earnout that was incorporated into the transaction was way too aggressive. They didn't consider what was the appropriate structuring. They didn't consider if they wanted some type of rollover interest. They didn't do their due diligence on the buyer to make sure that it would be a good fit and that their key employees would be taken care of post sale. They didn't consider what they plan on doing with all this additional time that they have, going forward. I mean, you would be shocked with the amount of clients that I have had that have sold their business, and 1 or 2 years later, they're already looking for a new opportunity just because they're bored. These are folks that are in their mid to late 50s, early 60s. They still have, 20, 30 years ahead of them. They're entrepreneurs, so they tend not to like to be in one place at one time, and they need something to do. Um, so it really is just the lack of planning and lack of bringing qualified professionals in advance of the transaction.
I think for some of those folks, the serial entrepreneur is pretty hard to fix. I mean, that's just what they do. I like the folks that says, yeah, I'm going to retire to Florida and play golf. Go, well, you been to Florida? No. Play golf? No. Do you think about renting and maybe trying it out? I had one guy says, I think I'd like to fly. And I go, well, have you ever flown a plane before? No. Maybe you go out and take a lesson, see if you just like flying with you, kind of thing. So, um, and I think for the folks in my observation is they're so worried and focused about getting to the closest. I'll worry about all that other stuff after I've gone past the altar. I think there's a bunch of that, truly. So, for the family or the owner that doesn't have the luxury of 2 or 3 years, there's, death or divorce or health issues, and they don't have the luxury of a long runway with you folks. How do you adjust what you do for the folks that have, a life event that causes an exit early? How do you help them then, different than having a big runway?
Yeah, we try to identify all the skeletons in the closet just so we're aware of what the potential pushback could be during due diligence. And again, that's why it's important to understand this in advance of the LOI, because if we know what those pressure points are, we could be a bit more aggressive in the LOI and at least be a bit more communicative on setting the expectation with our client of, hey, if they realize that, you had a significant warranty issue last year, 2 years ago, this is how it might impact your sales price today. So it's really good to just understand have a good feel of the institutional knowledge and the institutional risk that exists at the organization. Make sure you bring in an M&A attorney so that they're aware of it as well. Having an idea of what all those risks and exposures are, tailor the LOI appropriately, and again, just set the expectation up with my client, the seller, and knowing how it could adversely impact your sales price.
What strikes me, I think it's an unfair benefit is I learn so much from these episodes and from folks like yourself that are, very experienced, and have kind of been down the road and been down the bumpy roads too. So, for the owners that are out there, whether they're in the Detroit area or not, that are in the manufacturing space, and they're not sure whether they're in the slot to sell, but they're 2 to 5 years out if they're going to. How do they find you and how do they reach out to you? And what does that first conversation look like?
Yeah, so I would suspect you would probably share my contact information in this podcast. So
I'll tell them.
you could look me
Yep.
up on blueandco.com. But that first discussion is really getting an understanding of what are your ultimate goals. Let's not even talk about the dollar amount. Let's not talk about the enterprise value. How do you envision living your life post sale? From that perspective, what's important to you? Is it the dollar amount? Is it the legacy? Do you want, a bite of the apple down the road? Do you want to try to sell it 100%? Like, it's first understanding what their goals are holistically and what's important to them before we even start talking about a transaction. And with how the market's been the last 5, 6, 7 years, you never know who's going to knock on your door. You always have to be prepared because folks are getting unsolicited offers every day. I mean, I have clients who are telling me I'm getting 30 emails a day of someone wanting to buy my business. You always have to be prepared, and you never know what opportunities out there, and you never know what you'll be offered. So put yourself in a position where you're prepared for that knock on the door, because for all you know, you could be getting 2, 3, 4 times as much as what you expected.
It brings up many thoughts. The unsolicited offer. Yeah, I own another business besides this one, and I've had one from somebody's dog trying to get me. The dog is writing me a letter, and I'm going, well, that's unique and different. That's kind of speeded up as it went to the trash can. But, it's a distraction from operating, I think, to get the unsolicited offers. Um, for the owner that's looking at another bite at the apple, what type of framing or advice do you offer to that business owner about the nature of that second bite? What they should look for, what they should prepare for? Is there a service that you guys offer in that arena?
There's not a specific service that we offer in that arena. I think the most important part is really doing your due diligence on the buyer. And again, one, making sure that the values align. From my experience, where I've seen the most frustration out of sellers is dealing with their ex management team, their ex employees, with their legacy, and how new buyers have come in and either eliminated positions or just didn't treat them with the same level of respect as my client did. So if you're going to have a rollover interest, you want to make sure that you feel comfortable showing up to the office and not feeling ashamed that you sold your business to a buyer who's not treating your ex-employees as favorably as you did. That's number one. And then obviously you want to make sure that they could execute um, profitably, because there's a lot of PE firms out there. I mean, we see PE firms that are popping up every day, and as many that pop up are as many that go, under in any one given year, because it's kind of like the Wild West right now. And, going through and facilitating a leverage buyout analysis or leverage buyout transaction is happening all the time. And you really have to trust the operators that you're leading your business with.
If you were to envision for a business owner the ideal, not the money necessarily, but their life and the structure of their life 18, 24 months after exit, what are the key markers that you think would be the hallmark of a really good exit, and how you drove that exit?
Yeah. Um, Kind of just to reiterate what I just said, when you show up to your old facility, are your employees happy? Do they greet you with a smile, and are they thankful that for your years of service and their years of service for you with you, and are they happy with who their existing employer is? Like, in my opinion, that's one of the most important aspects and elements. Obviously, post transaction financially, meeting all the metrics that you were expected to, the earn out requirements, that you got back all your holdouts, your holdbacks, so that was all paid out. That you are in a position to use your proceeds to divest however you like, that you're living your lifestyle that you envisioned before the sale, and that you're happy.
Yeah. Do you often see your clients, 2, 3, 4 years after exit?
Well, yeah, and about 95% of the cases, because we continue to do their compliance returns. And
Sure.
yeah, usually folks that with large sale proceeds, will get into real estate because of the favorable tax laws, or will, invest in alternative investments. And likely, prior to the transaction, they set up trust and they did some estate planning. So we're doing the trust work as well. So probably even more than 95% of the cases, maybe 98% of the cases, we still maintain those relationships well beyond the transaction event.
Well, you guys have been through the crucible together. They're either going to love you or hate you, one of the two. So, Ruben, oftentimes I have no idea what I'll hear in an episode. I really appreciate the expertise and perspective that you brought, to this episode. And for the folks out there, Blue and Co., Ruben Ramirez, and you can find him online. And it'd be the Detroit office, correct? So and in the show notes, we'll have how to reach you and your contact information and so on. So, Ruben, I appreciate you carving out time of your day to share the intellectual property that you've earned along the way. And with that being said, this is the Exit Series. If you know of a founder who's sold or is about to, or a broker who's seen it from an attorney who's been across the table, Send this episode to them and subscribe to wherever you listen. And if you're that business owner that's getting close, feel free to reach out to Ruben and have a discussion. And we'll see you next time. Ruben, thanks so very much.
Thanks, Bob. Take care.